Hi, and welcome back to the Business Career College video series. In this video, we're going to look at pension income splitting. Now, this is not Canada Pension Plan splitting. I have a separate video on that. This is all about pensions, registered pension plans. There's one non-registered pension arrangement we'll look at here. And this applies to those benefits other than Canada Pension Plan, certainly not old age security, which you never can split. So this pension income splitting is far more generous than what's allowed under Canada Pension Plan. Here, we care about the age of the pensioner only. The age of the spouse is pretty much irrelevant, although I'll show you why it does matter a little bit for sort of a secondary consideration. And unlike Canada Pension Plan, where you have to have been together and accumulated your Canada Pension Plan together to split it, here it doesn't matter how long you were together. So with Canada Pension Plan, if you have a couple who gets married in their 50s, their ability to split, or more accurately share, their Canada Pension Plan is very limited. Whereas with the pension income splitting rules, if you have a couple that gets together while they're in their 50s, they can split pension that they earned a long time ago before they ever knew each other. It doesn't matter. And this is going to be the same for married couples and common law couples. We don't make any distinction for any sort of different marital arrangements here. Anything that's normally considered for tax purposes married is considered married here. So what sorts of income can you split? What are we talking about here? There are two different sets of income that can be split depending on the age. So at any age, prior to 65, and so forth, you can split income from a defined benefit pension plan, which is a fairly common source of income, or what hardly ever happens. It's allowed under the income tax rules, but really you'll never see this, is income from a defined contribution pension. And the difference is that a lot of defined benefit pensioners will elect to stay in their pension, collect that pension benefit, and if they do, they can split that pension income with a spouse. Whereas defined contribution pensions typically don't offer that option. They will generally make you take a LIRA and a LIF, and that's got a different set of splitting rules, as we'll see momentarily. So only after age 65, you can split still the DB and DC. That doesn't change. Those are still available after age 65. But now you can split more stuff. So you can split a RIF, a Registered Retirement Income Fund. It has to have been converted to a RIF. You can't split income from an RRSP, although you can split income from an annuitized RSP. This is very rare today. I'm not aware of anybody who actually is using this at all anymore. This is really an old thing that was done prior to 1978. The RIF was only introduced in 78, and because of that, we don't have these annuitized RSPs anymore. The RIF has really taken on that role. You can split income from a LIF, which is essentially the same as the RIF for this purpose. And the weird one, the non-registered one, is you can split income from the interest portion of a non-registered insurance annuity. So if you bought a payout annuity from an insurer with non-registered dollars, you can actually split that with a spouse. Those are the only things that can be split under these rules. There are frequent challenges to these rules. People don't understand them. The form for this is a little bit convoluted. So the stuff you can't split here, CPP, it uses its own rules. You can't split old age security. You can't split, let's say, IPP. Now, you typically, with an IPP, are going to move that over to a LIF at some point. You can't split income from an RCA for whatever reason, the retirement compensation arrangement, which is a pretty fancy tool. The RCA often gets used or gets tried to be split and it just can't. There is one weird circumstance where an RCA can, if you have an annuity payable to the survivor of a deceased RCA participant, that annuity can be split. That's true. That's a little bit different though. Okay, but the RCA itself, the base income from RCA cannot be split. Okay, now these are the same criteria as for the pension income credit. The pension income credit is a credit of up to $2,000. It's no more than $2,000, but if you're only taking, let's say, $1,000 of pension income, then you only have a $1,000 credit. It's up to a $2,000 credit, but never more than that, and potentially less if you're taking less. So I know this can be a little bit convoluted. I find the easiest way to understand this is to walk through some scenarios. And our scenarios don't have to be overly complicated. So what we'll look at here with each scenario, we'll look at the pensioner's age, we'll look at the spouse's age, the spouse that person is splitting with, we'll look at the nature of income, and then my questions are, can it be split? Does the pensioner get the pension credit? And does the spouse, the recipient of the split, get the pension credit? Okay. So I'll start off with a fairly simple scenario here. I have a pensioner who is age 62. The spouse is age 57. And in this case, we're going to have income from a defined benefit pension. So this person never left their pension. They never took a LIRA or a LIF or commuted value or whatever. They've stayed with the pension and they're now enjoying their sweet monthly pension benefit. So can that pension be split? Yes, that person is any age and collecting income from a defined benefit pension. Do they get the pension credit? Yes, the pensioner is any age and getting defined benefit income. And does the spouse get the pension credit? Yes, the spouse is any age and now, by virtue of a split, getting that pension income. And now we'll work through another fairly straightforward scenario. Now I have a pensioner who is age 68. This person has a spouse age 61. And this time we're taking a RIF withdrawal. And I don't care if it's your scheduled RIF withdrawal or if it's a one-off withdrawal, a larger withdrawal, whatever, doesn't matter. All that matters here is that it's RIF income and my pensioner is over the age of 65. So yes, it can be split. And I have a RIF annuitant over the age of 65, so it can qualify for the pension credit. The spouse, though, in this case is not 65, receiving RIF income, but isn't old enough to get the pension credit. And now in my next scenario, I have a pensioner who's age 70, the spouse is age 66. Again, we'll have that RIF withdrawal. And now, can it be split? Yes, it can. Pensioner is over the age of 65. Is there a pension credit for the pensioner? Of course there is. They can split, they have the credit, those two things go hand in hand. And now the spouse over the age of 65 also has the pension credit available. Now, for my last scenario here, I'm going to show a slightly trickier scenario. So now I have a pensioner who is age, let's say, 61. So not yet 65. And they're collecting income from a survivor's benefit. Their first spouse died and left them a survivor's benefit from a DB pension. Here, this person since remarried, so now they've married, let's say, a 58-year-old, that's the new spouse. And now we're looking at a survivor's benefit. But it's a survivor's benefit from a defined benefit pension, and you'll probably expect that it can be split, which would be correct. You'll probably expect that the pensioner can get the pension credit, that's correct, and the surviving spouse, the new spouse can get the pension credit as well. So that's pension income splitting. I hope that helps. I hope you're able to apply those to real life circumstances. I've certainly tried to give you 4 real life examples here. I do find that's the best way to learn this. Look at those real life examples and apply it there. The rules are actually not that complicated. It's, are you 65? Yes. Then more splitting is available. Prior to 65, really, practically only the defined benefit pension is splittable. For planning purposes, this has lots of implications for planning purposes. This is one of the reasons potentially to stay in a defined benefit pension rather than take a commuted value and move to a LIRA and LIF, because you have more splitting available. We can see this with the 62-year-old that I drew up over here. If this person had chosen to take a commuted value and leave their defined benefit pension, then they wouldn't be able to split any of this until age 65. They might pay more tax as a result. Their spouse won't get the pension credit as a result. So this does have some very real planning implications. At the same time, a lot of people say, well, when pension income splitting came in, it really killed the spousal RRSP, and I don't necessarily agree with that. Keep in mind, you have to be taking RIF income to make this work. It may not be in your best interest to take that RIF at 68 or 66 or whatever the case is. So you may prefer to keep funds in an RRSP, not be subject to RIF minimums, and simply take out what you need. And for that reason, if you're looking for a pre-65 income split in retirement, we'll call it, or if you're looking for a pre-71 income split without having to RIF, then the spousal RRSP is still very valid. And I think that it's useful to still look at retiring couples, ideally retiring with roughly the same balance of invested assets for each of them. So I hope this helps. I hope this helps you to understand pension splitting. You'll need this at pretty much all levels of any financial services exam. It's a very commonly tested item. I hope you do enjoy your continued studies. Thank you very much.